December 9th, 2025, silver just smashed through $60 for the first time in history. But that's not the story. In Shanghai, warehouses that held over 3,000 tons of silver 5 years ago, they're down to 687 tons, a 78% collapse. And 50 industrial buyers are fighting for what's left. This isn't speculation. This is happening right now. Disclaimer. I'm not a financial advisor. This isn't financial advice. I'm not affiliated with anyone mentioned here. This is educational analysis based on publicly available information. Always consult professionals before making financial decisions. October 2025, China shipped 660 tons of silver in a single month, record high. All of it headed to London, where vaults were reportedly running dry and lease rates exploded to 39%, the highest ever recorded. When you air freight a metal that normally ships by ocean because it's too heavy and too cheap to fly, something is broken. And when the US government designates silver a critical mineral for national security, they're not guessing. They know something. 3 times in the last 100 years, this exact pattern appeared. Each time, silver didn't just rise, it exploded. 2x, 5x, even 37x. And right now, we're watching pattern number 4 form in real time. Let me show you the pattern. Think of it like musical chairs. Stage 1, everyone's dancing, music playing, everything looks normal, nobody's worried. Stage 2, someone quietly removes chairs. Nobody notices because the music's still loud. Supply shrinks, inventories drain, but prices stay calm. Stage 3, the music stops. Panic. Everyone realizes there aren't enough chairs. That's when prices spike. Stage 4, fight for the last seat. Chaos. Winners and losers get decided fast. Right now, market analysts believe we just entered stage 3. The music stopped. Here's the evidence. China's Shanghai Futures Exchange stockpiles dropped from over 3,000 tons to 687 tons. London lease rates hit 39% in October. Absolute record. The US just added silver to the critical minerals list, air freighting a metal that should ship by boat. These aren't random events. They're warning signals. And history shows what comes next. 1933, April 5th, Franklin Roosevelt signs Executive Order 6102. Americans had to surrender their gold to the government at 20.67 per ounce. No choice. Comply or face prosecution. But the government didn't stop at gold. 1934, Silver Purchase Act. Treasury started buying silver at artificially high prices to control the money supply. Result? Silver went from roughly 0.44 per ounce in 1933 to approximately 0.81 by 1935. Nearly doubled in 24 months. Not because silver became more useful, because physical scarcity drove the price. When supply gets locked up, prices must rise. August 15th, 1971, Sunday night. Nixon interrupts TV programming with an emergency announcement. The United States will no longer convert dollars to gold. The Bretton Woods system, foundation of global finance for 26 years, ended in one sentence. Why? Foreign governments were draining Fort Knox. U.S. gold reserves had dropped from approximately 20,000 tons to just 8,000 tons. What happened? Gold exploded from $35 to $850 by 1980. Silver followed, from around $1.50 in the early 1970s to $48 by January 1980. That's a 32-fold increase in less than a decade. Yes, the Hunt brothers made headlines, but they didn't create the shortage. They rode a wave that was already building. And the fundamentals drove that move. Limited supply, exploding demand, government money printing. September 15th, 2008, Lehman Brothers collapsed. 4th largest investment bank in America vanished overnight. The global financial system went on life support. Governments responded with unprecedented money printing. The Federal Reserve's balance sheet reportedly exploded from around $800 billion in 2007 to over $4 trillion by 2015. Investors noticed. They bought physical gold and silver. Coin dealers ran out of inventory. Mints couldn't keep up. By April 2011, silver hit $48.70 per ounce. From under $9 in 2008 to nearly $50 in 2011. A 5x gain in 3 years. Now here's what should make you pay attention. Each cycle takes less time. 1933 to 1935, 2 years. 1971 to 1980, 9 years. 2008 to 2011, 3 years. The cycles are accelerating. And the current cycle, it reportedly started in 2020 with COVID money printing. We're 5 years in. Many analysts believe we just entered stage 3, the scramble phase. Let me show you what's happening right now. This isn't speculation. This is verifiable data. March 2020, COVID hits. Governments print trillions. But something else happens quietly in the background. Industrial demand for silver surges. Solar panels require approximately 1 million ounces per gigawatt. China installed over 250 gigawatts in 2024 alone. That's potentially 250 million ounces just for Chinese solar. Electric vehicles, every EV uses 1 to 2 ounces of silver, production ramping globally, 5G infrastructure, AI data centers, technology that didn't exist 10 years ago, all require silver. According to industry reports, global solar demand hit substantial levels in 2024, but mining production can't keep pace. Analysts suggest we're running consecutive years of deficit. Cumulative shortage potentially in the hundreds of millions of ounces, yet prices stayed suppressed for years. How? The paper market. For every physical ounce of silver, there are reportedly between 100 and 400 paper claims. Banks hold massive short positions, selling contracts for silver they may not actually have. This keeps prices artificially low. But something shifted. China flipped from net importer to massive exporter. 660 tons shipped in October, highest volume ever recorded. Why? London was reportedly in crisis. Physical metal was scarce. Lease rates exploded to 39% annualized in October, the highest on record. When lease rates spike like that, it means one thing. Nobody wants to lend their metal because they're worried they won't get it back. November 6, 2025. The U.S. government officially designated silver as a critical mineral. This isn't symbolic. Section 232, tariff investigations followed. Potential import duties ranging from 15% to 50%. The U.S. imports a significant portion of the silver it consumes. What happens next? Precautionary buying. Reports suggest substantial amounts of silver have flowed into U.S. vaults since October. Industrial users, investors, institutions, everyone scrambling because if tariffs hit, imported silver could become dramatically more expensive overnight. Meanwhile, in China, the vaults are depleting. Shanghai Futures Exchange, down approximately 78% from pandemic peaks. Shanghai Gold Exchange, reportedly the lowest level since 2015. And here's the critical signal. Chinese spot prices reportedly trading at a premium to New York. When that happens, it typically means the paper game is breaking. Physical metal is more valuable than paper contracts. Some analysts say China will release hidden reserves to stabilize the market. Maybe. But here's my question. If China had massive hidden reserves, why drain public stockpiles by 78%? Why export 660 tons in 1 month when they could wait and sell at higher prices later? The behavior doesn't match that narrative. Either the reserves aren't there, or they're being held for strategic reasons that override profit. Either way, the physical shortage appears real. This is where it gets interesting. And we're not at stage 4 yet, but many pieces are in place. Right now, there are reportedly substantial amounts of silver in open paper contracts on COMEX. Physical inventory available for delivery, a small fraction of that. High leverage ratio. If even 10% of contract holders demand physical delivery, some analysts believe the system could face serious challenges. They might have to settle in cash. And when that happens, trust in the paper market evaporates. Industrial users panic. Solar manufacturers need silver now. Not next quarter, not next year, now. Production lines shut down without it. They'll pay massive premiums to secure supplies. Then governments step in. When silver hits $75 or $100, politicians launch investigations. They impose export restrictions. And each action makes the shortage worse because it signals to everyone paying attention. This is real. The government's concerned. Hit subscribe right now. What's potentially coming next could be one of the most important wealth events of this decade. And I'm breaking down every stage as it unfolds. Here's where analysts believe silver is headed. Primary scenario, $90 to $100 per ounce by mid-2026. That represents approximately a 55 to 70% gain from current levels around $58, $60. This assumes continued physical shortages, potential U.S. tariff implementation, and accelerated industrial panic buying. Analyst Larry Lepard told Investing News Network he sees $75 by mid-2026, potentially $80 or $90 by year-end. Analysts at major banks have discussed targets exceeding $100 by the end of 2026. That's the base case. But there's a possibility we could see something more dramatic. If COMEX faces delivery defaults, if governments impose export bans, if investors flood into physical metal all at once. Some projections suggest $120 to $170 by summer 2026. That would represent a $100 to 190% gain. Sound extreme? In 1979 to 1980, silver went from around $6 to $48 in 14 months, approximately 700% gain. In 2010 to 2011, silver went from $70 to $49 in 10 months, around 188% gain. Here's fascinating context. When you adjust the 1980 peak of $48 for inflation, that's approximately $178 in today's money. We're at $58, $60 right now. We haven't even reached the inflation-adjusted all-time high yet. Silver at $60 may not be expensive. It could be artificially suppressed for decades, finally breaking free. How should you think about positioning? You don't need to predict perfectly. You need to understand the risk and act accordingly. If you believe China's vaults are truly depleted and this pattern is completing right now, consider focusing on physical silver, coins, bars, allocated storage. Some experts suggest avoiding paper ETFs that may not have the backing they claim. Consider securing your position before potential tariffs hit and premiums spike higher. If you think the shortage is real but maybe not as severe, consider a moderate position. Diversify across precious metals. Set price alerts for key levels, $65 and $75, $90. Reassess as new data comes in. If you're skeptical, that's fine, but watch the signals. Lease rates, COMEX inventories, government actions, Chinese export data. The pattern doesn't require you to believe in advance. It just requires you to pay attention when the evidence becomes clearer. Let's be honest about what could go wrong. China could release off-exchange reserves we don't know about. Demand could collapse if prices hit $100, and industrial users find substitutes. The economy could crash, and deflationary pressure could dominate temporarily. Government intervention could continue longer than anyone expects. Those are real risks. But here's my perspective. Physical shortages don't care about paper prices. If there's no metal to deliver, the paper game ends. And if the economy crashes, governments print even more money. Crisis equals printing. Printing favors hard assets. That's the historical pattern. As of December 9th, 2025, silver recently set a new all-time high above $60 per ounce, currently trading around 58.60, consolidating near record levels. But that's not the key story. China's vaults depleting. London's lease rates hit record highs. U.S. declared silver a critical mineral. Substantial cumulative deficit, multiple consecutive years of shortage. Air freight for a metal that should ship by boat. Significant paper leverage on COMEX. Those aren't random facts. Many analysts believe those are warning signs that appear right before stage 4, right before prices move in ways most people won't believe until it's too late. Remember that musical chairs analogy? We're past the part where the music stops. We're in the scramble. People realizing there aren't enough chairs. The last person standing will pay whatever it takes to secure a seat. You asked which historical example this mirrors most closely. Here's my answer, all three. We have elements of 1933's government intervention. We have aspects of 1971's monetary system shifts. We have characteristics of 2008's financial panic and money printing. All three patterns potentially converging simultaneously. That's why this cycle could be bigger than anything we've seen before. The question isn't what happens next. The pattern has shown us 3 times already. The question is, will you be positioned if it completes? If you found this analysis valuable, drop a comment right now. Tell me, do you own physical silver, paper silver, or nothing at all? Just write physical, paper, or nothing. I want to see where everyone stands, and if you know someone who needs to see this, share it. What's potentially coming could separate people who prepared from people who waited. Thanks for watching. I'll see you in the next one.